Hello and welcome to this session. This is Professor Farhat, in which we will discuss internal control deficiencies. In the prior session, what we did is we talked about under what circumstances do auditors, under what type of engagement they are responsible for internal control engagement. So when we are performing an audit and the auditor identify issues in an organization internal control, what should they do? Well, they should report this information. But when we face an issue, a control deficiencies, we have to classify those control deficiencies. And in the prior session, we listed the control deficiency. It could be a control deficiency, could be a material weakness, or could be a significant deficiency. And in the prior session, I told you in this session, I will discuss each one of those three deficiencies, going from control deficiencies to material to significant. This is what we will do in this session. Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses, broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today.
Starting with the control deficiency. What is a control deficiency? A control deficiency occurs when internal control fail to effectively prevent, detect, or correct a financial statement in a timely fashion, promptly. And those control deficiencies are categorized into two types. We could have a deficiency in the design of the control. What does that mean? So you have to understand what is design and what's an operation. Design is the way it's designed, the way it's mapped out. The instructions are no good. Occur when a necessary control either it doesn't exist or it's not properly structured to achieve its internal control goal. For example, a company does not have a procedure requiring approval for large expenditure. They simply don't have this process. They don't have the approval. As a result, they have a control deficiency. It's in the design. They don't have it. Or if they might have a control, a procedure requiring approval of large expenditure, but we need one signature. And the proper one is we need two signatures. Therefore, the design is no good or it does not exist. This is what we mean by a control deficiency in design. So that's separate from operational deficiency. The problem now is not in the design. The problem is the internal control that's designed properly is not operating in the proper way. So operational deficiency is different than a design deficiency. This happens when the controls are well designed, so have no problem with one. We don't have problem with the design, but we have the problem with the execution. The control is not being carried out properly because the person is not performing them properly. They're not adequately trained. They're not adequately supervised. Things are not being followed. So for example, a clerk is responsible for reconciling bank account, but this individual lacked the proper training and fails to detect the fraudulent transaction in a timely fashion. The design is there. You're supposed to do a bank reconciliation, but the person doing the bank reconciliation is not properly carrying their job requirements. So this is an issue in operating deficiency. So that's a control deficiency. Then here on a color, it could either be blue or green. Basically, either a design problem or an operational problem. I don't know which one you want to assign to. It doesn't really matter. I'm going to go from the blue and the green to the red. A major problem, material weakness. The deficiency could be a material weakness, and this is a severe. Notice I have it in red. It's a severe deficiency in internal control or a combination of deficiencies. It could be several other deficiencies, but in combination, they are severe. This creates a reasonable possibility, a good chance that a significant financial statement will not be prevented or detected or corrected timely. This is not, it's a possible, that's a good chance, reasonable possibility. Reasonable possibility means the event is either reasonably possible or probable. A high probability that this event will occur, a problem would occur. We will not detect it and the problem is severe. So the accounting department repeatedly misses reconciling critical account, leading to potential material misstatement in financial reports. Now we're not looking at the bank statement. We're looking at the bank statement, at the AR, at the AP. They're not reconciling their accounts. And this is a material weakness, and this is red. Now we're going to go to the middle, which is yellow, and this is a significant deficiency. Significant deficiency is less severe than a material weakness, but still merits immediate attention by management and those responsible for the governance. So it doesn't reach the threshold of being materially impactful, but it's important enough to inform management and governance promptly. And we're going to talk about how do we inform them shortly. An example will be management lacks a formal review process for unusual journal entries, potentially allowing errors to occur unnoticed. So yes, sometimes we have to prepare journal entries for certain transaction. That's fine. But the problem is because those transactions are unusual, they lack a review process. So no one is reviewing them. And because of that, potentially we are allowing errors to occur unnoticed. So from a coloring perspective, remember we said control deficiency could be a control in the operating the control or in the design, which I said I'm going to assign them the blue and the green color, which is kind of not minor, but they're not as major. Then we have a material weakness, which is red, and in between we have the yellow, significant deficiencies. Now we're going to focus more on the material weakness, and the reason is because material weakness are tested, and there are certain indicators of material weakness. When we have a material weakness, it means we have a serious problem, and on the exam, they will tell you there are certain things you have to look for. How do we know this? Well, if you look at previously released AUD CPA questions, they tell you in the question which of the following situation merit a material weakness deficiency. So there are certain indicators. Well, one is any fraud conducted by senior management, and the answer is any fraud. The reason I say any fraud, because in the problem, what we see in the question is they would say fraud committed, but the material is not, but the amount is not material. If it's senior management, upper level, it does not matter because this goes to their integrity. This question their integrity. How serious are they about the cultural values of the company? It's automatically a significant red flag, and it's flagged as material weakness. For example, if the auditor discovered that the CFO altered financial record, this automatically signals a material weakness, even if the amount is minor. In the question, they would say it's minor, it's immaterial, it does not matter. And this will demand immediate attention by the governance body. Another one is material weakness is a restatement of previously issued financial statement. When we restate financial statement, it means what? There is a problem. Needing to correct past financial statement due to significant errors indicate severe control issues. That's another material weakness. So we have to be aware of that. If the auditor identified a significant misstatement, discovering errors during the audit that the company internal control should have identified. They should have identified, they did not identified by their internal control. That's a material weakness. Or poor governance. Simply put, it's because remember, we're communicating with those top people. If those top people are not effective in monitoring the company, poor supervision, they're not really taking responsibility for the oversight of the company, then we have ineffective oversight by the audit committee or the board of directors, and that by itself is a material weakness. Here we have to go back to the internal control. Remember the tone at the top, the controlled environment. If the controlled environment is no good, we have a serious material weakness. Let's take a look at this multiple choice question from farhatlectures.com. You discovered that LMN Inc. has several minor internal control deficiencies that are individually insignificant. What should you consider when evaluating those deficiencies? Okay, so we looked at them. They are kind of control deficiencies, but individually they are insignificant. Okay, so how do we evaluate them? Only the magnitude of each deficiency individually. Do we look at the dollar amount or the volume or the size of each one of them individually? No. Even though individually, we still have to look at all of them combined. So only the magnitude of each, I would say it's not a good answer choice. Let's take a look at B. The likelihood and magnitude of potential misstatement individually and collectively. I would say yes. So how do you evaluate minor internal control deficiencies? You would look at both. First, likelihood and magnitude, both, not only the chance of that internal control deficiency occurring and the size, the consequences of that occurring, and you would look at each one of them separately and you collect them and you would look at them in aggregate collectively. I would say B is better than A and looks like a good choice. The number of deficiencies only is not a good choice. The number of deficiencies matter. The more you have, the worse off you are, but you don't only look at the numbers. The operational impact on employees' daily tasks, you would look at that, but that's not the only thing you would look at. You would look at the magnitude and the likelihood of each and collectively. The answer is B. What should you do now? You want to go to Farhat lectures, look at additional resources, multiple choice, true false, simulations, anything that you can use to prepare for the CPA exam or for your auditing course. The best investment you can make is invest in yourself.